Hello, all you beautiful people. Mike Ferrossi here again with my partner in crime, Jonny Fowler. Welcome to the Fly the Flag podcast. How you doing today, Jonny?
I am doing absolutely wonderful. It is the beginning of fall season. We are days away from getting on a plane and coming to Southern California to be part of the AFM branch manager convention. You'll get a kick out of this. I got a message from one of the branches that I referred to come over here.
Okay.
That worked for me like 15 or 20 years ago. And I just got this message a little while ago, and I was going to tell you about this. But one of the things that I loved is she wrote in here, blah, blah, blah. Well, I will see you there. AFN is the bomb. Really late to RSVP, blah, 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 blah. So that made me feel really good. I liked that one, but I'm jazzed. I'm looking forward to this conference.
I am too. We're going to have a lot of new faces there, including yourself. And as somebody who's been a part of this for years and years, I can say that it's a great conference, lots of great information, and we throw a pretty darn good party. So we're looking forward to having fun with everybody.
I was looking at that. I was looking at the conference schedule and all of that stuff. And we've got the world famous Barry Habib as a keynote speaker.
And that's a great, and what a great segue, because we got a guest for you today. Today on our podcast, which of course is a mortgage podcast that talks about mortgage things with mortgage people, we have one of the best and brightest mortgage people around, Mr. Dan Habib. Thanks for joining us, Dan. How's it going, brother?
Hey guys, I'm doing great, man. Thank you for having me. And I got to tell you, from someone who's gone to the AFN event now for many years, boy, you guys do sure throw a good party.
There you go.
I think it was, I don't know if it happened last year, but the last time
2019, I think, was our last one.
Yeah, the last time I was there, they had girls with gowns that had like champagne glasses built into her gown. They had people with all these lights on them dancing around. It was something else. It was a lot.
Was that the one where we set up the little arcade?
Yes, it was.
Yeah, outside of the dining hall. Yeah, it was fun.
Great learning there and such too. So, and then I get a chance to work with a lot of companies, and you guys at AFN are not only a great company but great people. And Jonny is someone who's always been a close friend. Looked to him as a mentor. So, great that you guys have Jonny there now as well.
I am so lucky. I've got to watch Dan grow up in this business. I've got to watch him as he started speaking. And one of the things that I try and do, I absolutely adore Dan. The whole family, but I absolutely adore Dan. And one of the things that I try and do is just send him a message every once in a while, like when he does a really good show, or he is honestly and I don't mean this in a derogatory way. Because I say he's one of the smartest kids I know. He is one of the smartest humans I know. And I'm so lucky and so blessed that he's on here with us, because, so many people are just single faceted. And the idea that you can bring somebody on that has so much experience with, in my opinion, so few of years on this earth kind of deal. And the fact that the cool thing about it is, and don't tell his dad this, but he's like his dad times 2 or something, because any subject, anything, and that's one of the things, as we're leading up to this and bringing him into this podcast, we're talking about what it is, what we're going to talk about. The cool thing about what Dan is, it doesn't matter. We can talk about Jets football. We can talk about cryptocurrency. We can talk about blockchain. We can talk about mortgage. We can talk about real estate. We can talk about NFTs, whatever it is. And this is one of the reasons why I'm so proud to call him friend, is he can have a conversation. It's an intelligent, accurate conversation. So I'm blessed to be able to know this kid.
Well, thanks, Jonny. That means a lot coming from you.
So, Mike.
Yeah.
I assume you guys have met before and know each other.
We met once briefly at the conference a few years ago, and that's about it. We haven't actually gotten to spend that much time together, talk about too much, or get to know each other. But I got a feeling that's going to change here in the near future.
It is. You guys need to become friends. You're close to the same age, and just such a wide array between the two of you guys. And to me, and that's part of what my presentation is going to be at the conference, is paying attention to who the new customer is, paying attention to what is now coming out, as opposed to listening to the 75-year-old white guy that's been in the mortgage, business for 50 years that still doesn't know that there's such thing as a CRM or something like that. So I really want you guys to meld. It would be important to me.
Absolutely. I might have to exchange barbershop information with Dan, because I'm lacking a little bit here.
And I'll tell you what, no matter what his dad says, that's an awesome haircut.
Well, thanks, guys.
So Dan, I just want to get straight into it for a bunch of our viewers. We're catering mainly to mortgage industry professionals here, but there's some home buyers, there's some borrowers, a little more, I don't want to say affluent people, but people who have the urge to educate themselves a little bit more. So they're looking for mortgage industry type of education stuff as well. And it's mid to late September 2022. And everywhere you turn, there's a headline talking about how tough it is in the mortgage industry. And every Monday, we see basically a rundown of all the layoffs that happened in the past week. Like, it's a tough time for a lot of mortgage professionals right now. The refi boom has dried up, and purchases aren't exactly skyrocketing heading into the holiday season. We know you're on the pulse of the market over there at MBS Highway. Mm-hmm. What are you seeing? What are you hearing? Do you have a little nugget that could help one of our listeners, stay a step ahead of the competition, so to speak?
Yeah, no, it's a good question. And certainly we're seeing some more challenges out there, but compared to what, right? So I think having some perspective here is important. And if you take a look at what the estimated volume is going to be for this year, it's 2.4 or 2.6 trillion, right? Mm-hmm. So that's still historically a very good number. But if you compare it to the previous 2 years where you had a little over 4 trillion, it is a big decline. But that doesn't mean that there's not a lot of business out there. And I think everybody needs to kind of sharpen their toolbox a little bit here, because, the last few years when you've had business kind of rolling in and a ton of refinances, you didn't necessarily have to be as sharp or really work on your game per se. And I think that while it presents some challenges, if you're above and beyond or head and shoulders ahead of your competition, it presents a lot of opportunity to gain market share. Now, listen, let's not try to sugarcoat things. We certainly are seeing rates higher, right? Mm-hmm. So a lot of people refinanced previously. If you look at refinance volumes, they are down 83% or so compared to the previous year. Purchases, applications, they're down about 29%. And there's a lot of negativity out there. And listen, this isn't anything new, but the media is having a field day with some of the figures that are coming out saying that we're headed for a housing crash. So I like to kind of break down step by step, first of all, the interest rate situation, and then also what does housing look like from a straight perspective. So when we look at interest rates, there's a lot of misinformation out there. The biggest problem that we've been having is inflation, and it's not just a United States problem, it's a global problem. So as a result of this inflation, which, first off, inflation is what? It's too many dollars chasing too few goods. Well, how did we get here at 8.3% inflation? Mm-hmm. Well, it was a combination, in my opinion, of bad fiscal and monetary policy as well as COVID. So you had trillions of dollars of stimulus with good intentions, but, created a lot of money out there in the system. You also had the Federal Reserve, who had too easy of monetary policy for too long. They kept the Fed funds rate at zero for too long. They did way too much in the way of asset purchases. Trillions of dollars they've added to their balance sheet of mortgage bonds and treasuries, and that kept rates artificially low and promoted a lot of expansion, a lot more credit in the system. And, that's the too many dollars aspect of inflation. And then the too few goods, well, we know COVID crippled supply chains and they're still not back online. So the Fed, they're very reactionary. They don't see, too far down the chessboard, I like to say, because, they're too easy for too long. They don't have the foresight to see, hey, we're going to, overheat things. And then once they reverse course and they do that 180 and they become constrictive on the economy, which they're doing now, they do that for too long and then send us into a recession. So what is the Fed actually doing? The Fed, they have a few tools. One is their Fed funds rate. So the Fed is hiking rates, but the media would lead you to believe that means they're hiking mortgage rates, and they are not. So, the Fed funds rate is an ultra short-term rate. It's an overnight rate.
Can you just do me a favor? Just got to get it out there, Dan. Can you give me the quick one-word answer to the question, what does the Fed funds rate have to do with a borrower's mortgage interest rate?
Yeah. So nothing.
Nothing. It has nothing to do with it.
So
that's not true. I saw it on the news this morning. The 75 basis points is going to make your credit card go to 18% tomorrow. It's also going to make your interest rate on your mortgage go from 6% to 7%. It's going to make your payment go from $1,700 to $2,200. I saw it on the news this morning.
Yeah, and I've seen many news channels actually try to do like a little math example of, they're hiking 75 basis points.
Right. I don't have a fancy screen to pop up here, but let's go with
Dan's graphic and try and show that Freddie Mac's saying this.
Let's go with Dan's nickel tour of what the Fed funds rate is.
Yeah. So it's an overnight rate that banks lend to one another, and it does have a direct impact on short-term rates, but it is not a long-term rate or a mortgage rate that's theoretically in place for 30 years. Now, indirectly, it can have an impact, but not in the way that you think. So first off, when the Fed hikes the Fed funds rate, why are they doing this? They're literally doing this to try to destroy the demand side of the economy, to try to slow it down, to try to address this rapidly rising inflation. Now, first of all, it has a direct impact on short-term treasuries and short-term yields. Things like credit cards are impacted, or can be. Things like car loans, personal loans, small business loans. So all of those things can get more expensive and try to destroy the demand side of the economy by doing so, because if they can't do anything with their tools to impact the supply side. So literally all they can try to do is slow down the demand side of the economy. Now, indirectly, think about again what this is doing. They're doing this to curb inflation. But what's the main driver of mortgage or long-term rates? Inflation. So counterintuitively, if it's perceived, or if the Fed is successful by hiking rates in slowing down the economy, you can actually see mortgage rates come down. And we've seen this many, many times in history. Go back to Paul Volcker. He hiked the Fed funds rate by 9%, and you actually saw mortgage rates decline by 6%. You go to Alan Greenspan. He hiked the Fed funds rate by 1.75%. Mortgage rates came down by 3%. Now, this doesn't happen overnight, right? The way I like to explain this is, everybody's out there saying, the Fed's hiking. Well, if it's true that that's supposed to curb inflation, how come we haven't seen it yet? Or how come mortgage rates haven't improved yet? Listen, if I was sick and I went to the doctor and I got some prescription medicine, 5 minutes later, I'm not going to be dancing on the tables ready to go out, right? It's going to take some time for it to impact my immune system. And while it's true, the markets try to handicap the impact. If you look at the equity markets or the bond market, that can react, in real time to what it thinks is going to happen. But the impact on the consumer and reducing their spending and slowing down the economy, that could take 3 to 6 months per se from when the Fed hikes for that to filter its way through the system. So, if you ask me, what's going to be happening with inflation? Because if we know what's happening with inflation, then we know what's going to happen with mortgage rates. So I believe you're going to start to see by the fourth quarter of this year and beginning of next year, inflation start to come down by a more meaningful amount, as well as mortgage rates. And there's some clues that we can look at. So number one, the economy will slow down because of the Fed hiking and trying to slow it down. But number two, you also see commodity prices well off their highs. And the real main one that I think will have a big impact is how these reports are put together. So we look at the consumer price index or the personal consumption expenditures reports. Those are the two main inflation reports. But every month you get a new monthly reading, let's say for the consumer price index report. But it's a rolling 12-month report. So if you want to get the year-over-year number, which is really what everybody's looking at, you add up the previous 12 months monthly readings and you get your year-over-year number. But what that allows us to do is look to the future and see, well, what number are we going to be replacing from 2021? Because that's going to give you the bar of what is set. Now, we've been talking about an MBS Highway for a while that we thought these summer months, July, August, September, were going to be tough to see a meaningful improvement in inflation because they were very low. You had 4/10, 3/10, 5/10. These are all pretty low bars to be set for inflation. So even if you get a low inflation reading now in 2022, since you're replacing a low number, you don't see that big drop in the year-over-year figures. However, if you look forward to October, we still have to get past September. So you could have a little bit more bumpy road. You could see interest rates maybe get a little bit worse. But if you look to October, the numbers start to get much tougher on a comparative basis. So here's an example. October, the monthly reading from 2021 that we're replacing is 0.9%. Well, imagine if we just got another 1/10 reading like we saw in this past month.
Mm-hmm.
You'd see an 0.8 decline in year-over-year inflation. So, I think that if you look to the fourth quarter, we'll start seeing inflation and mortgage rates come down. Remember, you got the comparisons tougher. You got, things looking like they're cooling down and the economy slowing, which should help. But also, you have the Fed that's continuing to hike. Now, the other big thing out there is the Fed's hiking. They've done this many times before. Are they going to slow the economy too much and hike us into a recession? Now, a recession is not a great thing for the economy. Unfortunately, people do lose their jobs. You see unemployment move higher. But the silver lining is that historically it's a good thing for the mortgage industry because you always see interest rates decline rather significantly because, remember, recessions are deflationary by definition. Mm-hmm. So are we going to head for a recession? That's the big question out there. And I think almost everybody out there would agree that we're either in or headed for one, except for the Fed, right? Yeah. The Fed is like, sitting on a canoe that's like about to head over for Niagara Falls, and they just don't see, a few feet in front of their face that, we're about to fall off this cliff here. And the things that I look at, there's many indicators that would lead us to believe this. One is you have an inverted yield curve. This could be one that could be a little confusing to some people, but it's really not that difficult if you think about it, right? So a normal yield curve is up and to the right. What that means is that, hey, if I put my money away for 2 years versus a longer period of time, like 10 years, well, as I put my money away for a longer period of time, I'd expect to get rewarded with a higher rate of interest or a higher yield. So that's normal yield curve. Well, right now, the 2-year yield is much higher than the 10-year yield. Now, that sounds kind of backwards or upside down or inverted, and it is indeed an inverted yield curve. So if you were to take the 10-year minus the 2-year, right now it's negative 30-something basis points. Now, why is this important? Well, first of all, it's a symptom or a sign of a lot of weakness in the economy. You're being rewarded in the shorter term, meaning there's more risk and fear and weakness in the short term than the longer term. But also, if you just look at the pattern, almost every time you see an inverted yield curve, you get a recession to follow. So that's one indicator, right? The other one out there is you have 2 consecutive quarters of negative GDP. And up until the NBER, it seems kind of, and that's the National Bureau of Economic Research. So they're kind of like the referee that calls if we're in a recession.
Thank you for putting that out there for us little people who don't know all the acronyms off the top of their head.
Yeah, so they're the referee out there. Well, they've come out and said, and I don't know about you guys, but as long as I could remember, going back to my economics classes, 2 consecutive quarters of negative GDP is a recession, right? And
100%.
It's a Wall Street definition.
That's the Wall Street definition as well, right? So now they say that you need a certain amount of economic contraction that has a certain depth, duration, time period, as well as diffusion, meaning widespread. But, if you look back, like 1947, we've never seen 2 consecutive quarters of negative GDP that wasn't classified a recession. But they're always looking.
Let's be honest. I mean, all of that just sounded like a really fancy way to say nuh-uh.
Yeah, exactly. Right?
Like,
so if you look at Q1, we had negative 1.6%. Q2, negative 0.6. Q3, they just revised this thing sharply lower, now to 0.5, but it was, 1.5%, a little bit higher than that previously. So clearly seeing signs that the economy is slowing into Q3. I wouldn't be surprised if that was negative as well. But the bottom line is I certainly think we're either in or headed for a recession, and they won't call this thing till after the fact anyway. It's never like you have the NBER say, we're in a recession now. It's always like, hey, 6 months ago, we were in a recession. Right?
The definition made that.
Now we're
made it that way. Like you couldn't know you were in a recession until you were already in one for 6 months.
Mm-hmm. And now here's the other thing. The one thing that I see so many people in the media, in the Fed, holding their hat on is, well, how could we have a recession with the unemployment rate so low? And the fact of the matter is you don't get a recession when the unemployment rate's high. In fact, when it's high and begins to get a little bit better, that's when you get your next economic expansion cycle. Every recession, it's when the unemployment rate, and this is 100% certainty in every market cycle that you look at, you get the recession when the unemployment rate hits its lowest point and then begins to turn higher. Now, we've in fact seen it go to 3.5%, now up to 3.7%. But think about why this makes sense conceptually. If the economy is booming and doing well, the employment market's tight, right? There's a low unemployment rate. A lot of people have jobs. But then as soon as the economy begins to slow down, what happens? Well, first they got to either pause hiring or, unfortunately, they have to reduce headcount. Mm-hmm. Then this has a snowballing effect, and it perpetuates itself because now those newly unemployed, they're going to change their spending behavior. They're not going to go to the movies, to the restaurants, to the retail stores. And then all those businesses that were relying on that money, they contract. They have to reduce headcount. And then you start to see the unemployment really shoot up. But all these people out there saying, well, you can't have a recession when the unemployment rate is this low. That is precisely when you see a recession happen. I do believe we're going to start to see that move higher in the coming months. So listen, here's the bottom line of what I'm trying to explain to you. I think we're either in or 100% headed for a recession. But the silver lining here is that every time you see a recession, you see mortgage rates significantly decline. And when you take a look at how half the mortgage rates out there are above 4%, half are beneath 4%, and even with this being said, where rates are today, you're still seeing 30% of transactions are refinances, right? So there's always a reason to refi. But I think that next year, you can certainly see mortgage rates with a 4 handle in front. And I think that will spur a lot of activity in our industry from both a refinance and a purchase standpoint. So,
especially with the piles of equity that so many people are sitting on right now.
Record levels
heading into the holiday season. I live in a college town. I see 5-figure tuitions walking up and down the street every day. There's always a reason to tap into that home equity, right?
For sure. And, the housing market, I think, is extremely healthy, from an individual standpoint, right? Like you said, record levels of equity. And also, you have to remember that there's easy ways that you can lie with statistics. And there's some companies out there that are very egregious with this. One is Atom Data Solutions. Okay. So they always have a negative spin because, listen, negative spins, that gets eyeballs, right? But they're like, foreclosures are up 150% from last year, right? Yeah. And it would almost be like if I said this, right? Let's pretend that there was one home for sale of inventory. And then the next year there's 2 homes for sale. Technically speaking, right? Inventory is up 100%, but there's only still 2 freaking homes for sale. Right?
Exactly.
So they're changing the definition of unemployment.
Yeah. So essentially, yes, from a year when you had almost no foreclosures and you had moratoriums where you couldn't even do a foreclosure, it's up 150%. But from a more normalized year, it's down 54%, like 2019. Right. And if you compare it to when you go back to the housing bubble days, you had 1 million. Now you have 100-something thousand. So, much, much healthier.
Dan, I want to ask you a question on that because you just brought up a good point about the housing bubble. 2 things that I see rampant all over social media, which is wrong. Both of them are wrong. And I try and help as many people as I can. But I'm seeing this a lot, not only in just mortgage groups, things like that, in the big real estate groups that are on social media also. 1, tell me why this is different than 2008. 2, because this is where I think some more educated people are leaning. Tell me why this is different than the late 70s, early 80s with Carter in office, with interest rates, the highest that we've ever seen recorded. Why is this different? I know why it is. Dumb it down for us.
Yeah, so I think the big one that I'm seeing people compare this to is the housing bubble that we saw, 06, 07, and the 08, 09 recession that followed. Yep. One of the big mistakes people, I think, make is that they hear about recession today and they think that the recession caused the housing bubble, when in fact it was the opposite. The housing bubble really brought the U.S. into a recession. But I like to look at supply and demand because that's always going to be determinant of price. And you have a lot of fear mongers in the media saying we're going to have another crash, 30% declines. Well, if you go back to 07, you had 3.81 million homes for sale. And there was an abundance of supply. Builders were overbuilding. And then you did have a decline in demand. But how is it different today? Well, you have 2.5 million less homes for sale, right? And yes, you are seeing demand decrease. But back then you had supply increasing and demand decreasing. Today, you have demand decreasing, but you still have very, very tight supply levels, right? So I don't think it's the same. And back then, housing was much more unhealthy. You had, probably not the best loans being done.
Exactly.
And a lot of the appreciation was driven by widely available credit. Today, it couldn't be more of a different, 180 scenario.
I love that you pointed to supply and demand as the first thing, because the first thing, I've always been a product person in the mortgage industry, so I always point to lending standards.
Mm-hmm.
And those two things together, the lending standards are so much tighter now. The loans that are being done are so much higher quality than they were back in 06, 07, leading into that Great Recession, in conjunction with the tight supply and demand that we have right now. I mean, we still have, just over 500,000 SFRs listed for sale nationwide? That's not a lot.
No.
Yeah, you bring up a good point. You bring up a good point because the flat out existing inventory numbers are extremely low. The last one was 1.31 million homes for sale in the U.S. And we'll get a new number on that actually tomorrow with the new existing home sales report. And a lot of people are pointing to the fact that we've seen inventory increase from the February and March lows, which it has a little bit, but again, off of a very, very low base. And this is actually a seasonal increase that we see every single year. And it has to do with people wanting to get their move done before the new school season. And then it crests and then actually begins to go down again. But to your point, while the existing home inventory is 1.31 million, that actually counts homes that are under contract. Now, I'm sure some of those contracts aren't going to close, but that's not available inventory. And about 500,000 or so of those homes are under contract. So, you're talking about 600 and something thousand active single family listings out there, which is still extremely tight. Now, yes, higher rates are keeping some people on the sidelines, and you definitely have less demand, but it's not looking like, to me, like you're going to see any kind of crash. The numbers there just don't support it. And it's very different than
and you're always going to have people sitting on the sidelines. Even when rates were in the threes, we still had people sitting on the sidelines waiting till the rates go down. When rates, this is something that it's always going to be there, but people will always need a property. People will always need a home, no matter what, unless you were born extremely good looking. Unfortunately, you have to live somewhere. And you have to pay a monthly payment no matter what.
Yep.
People have to do this. And one of the things that I think that's going to, and correct me if I'm wrong, one of the things I think is going to spur what all of the industry gurus are saying about, maybe a little spike or a head up in 2023 is I think all of those people that got stuck in leases over the past 24 months are sick of paying $2,400, $2,500, $3,000 a month in rent, and they realize even at a 6% rate, even at a whatever it is, they can actually own something and build equity. I think that's happening. What's your opinion?
Yeah, I'd agree with that, and I love what you said because it's very similar to something that I like to say. Where I see a lot of these economists out there and people in the media that are trying to almost compare housing to a stock, but there's a very big difference, right? So I could sell all my shares of Apple right now if I wanted to, and I'll be okay. But if I sell my house, what are my options? I could rent, I could buy another house, or I could be like Will Ferrell and Step Brothers, and I could be living at my dad's house till I'm 40 years old, right? So obviously that's not a great option. And when you look at rents, rents are elevated. They were almost keeping pace with appreciation. But remember, rents can continue to go up on renewals every single year. And while overall the increase in rents is double digits, renewals are going up somewhere between 6 to 8% per year, depending on your market. So, while the mortgage payment may be a little bit higher today due to an elevation in home prices as well as interest rates, that catches up very quickly from a cash flow basis with the rent because of the increases there. But then, of course, the appreciation, the amortization, maybe some tax benefits. I think that people are going to be pushed to still see the value in home ownership once, like you mentioned, Johnny, some of those things come due there. So listen, my opinion on the housing market is there's a difference between an activity recession versus a price recession. And I think that we're certainly seeing an activity recession,
Love that.
Based on the previous year. And the activity is
stabilizing.
much slower.
Mike and I were talking about that the other day, is stabilizing in the market.
Yes.
When people were signing contingencies or non-contingencies on appraisal waivers, and didn't care what it appraised for. I wanted that house. That's not a real market. That's not a stable market. That's not a sustainable market. We're getting back to, in my opinion, it's a more stable market. The value is there. If you want to pay $100,000 over value, that's on you. It's not a market fluctuation. We are in a stable market, and you're paying over. We are back to that stable market, in my opinion.
I like to think that we're moving out of housing as an emotion back into housing as an economy.
Yeah, great point.
Yeah, no, that makes a lot of sense. And there's a difference between like housing the economic driver, where you have like 15 to 18% of that contributes to GDP, and housing the investment, which is really what your customers care about.
Yeah.
Right. So when we talk about housing the investment, I still think that, listen, especially if you're going to be in the home for more than like a year or two, right? I mean, most people are going to be looking, past a 5-year time horizon. I think you're going to be just fine. Now, some markets from month to month, could you see if they were overheated? Could you see some price fluctuations, maybe month to month, some, maybe slight price declines in some markets? I think it's possible for sure. But, when I look at things from a national level, I think you're going to see those year-over-year appreciation numbers come down quite significantly. And the media is going to have a field there with that. They're going to say, oh, we've seen the biggest drop in home prices,
I know,
since X, right?
But it's crazy.
What they're talking about is instead of 18% year-over-year price appreciation, what if that comes down to like 5%? That's still home price appreciation. And also, if you look at the monthly numbers, I think you're going to, you could see, again, some fluctuations, but I think that you're going to see just a much slower pace of appreciation. Now, again, I want to caveat this. Some markets, it is very, very localized, but the bottom line is that getting past some of this noise, looking forward to the next 12 months, I think that you're still going to see low to mid single digit home price appreciation. Yes, and that still means a lot for a home buyer. And I always a big believer in, quantifying that for somebody, right? I mean, if you buy
I love that, because the noise gets loud. And I do want to talk to the home buyer here. The mortgage professional out there who's listening to this, you know better. Don't fall for the headlines. But the noise gets so loud for the home buyers out there. And it's crazy because as we talk about some of these stats, it's just like, oh my God, we're at crazy high record levels of homes with price reductions, which leads you to believe that all the headlines are saying that values are coming down left and right. But at the same time, you can pull another stat that says, well, but like 23% of all homes listed for sale are going under contract within 48 hours of when they were listed. Yep. So the market's still pretty hot. You can literally write a headline to say whatever you want.
How to lie with statistics, man. But
it's really
I like that one. What Dan was talking about, home values dropped by 13%. That's not accurate.
No,
they're still increasing by 5%. But compared to the crazy heyday,
well, you know what? I want to adjust what you said there about the price reductions, right? So those are like listing price reductions, right?
Yes.
So that doesn't
mean they were listed at the right price.
Exactly. And here's another thing, right? So the stat I just saw from Redford, it was like 24% of homes had price reductions. And the reason why they're making a big deal about this is it was 3 times higher than at the beginning of the year.
Sure.
Well, that means that, first of all, in like the hottest housing market we've ever seen, it was still around 8% saw pricing reductions, okay? So there's always some level of them, but what if we looked at the pricing reductions from more normalized, let's say 2019? It was like 20% saw pricing reductions on listings. So right now you're seeing 24%. That's certainly higher, but you have to compare it to something that's, a normalized market, not the hottest.
And they love to omit. And they love to omit that price reductions are a cyclical statistic anyway. We're heading into the holiday season. Price reductions always go up heading into the holiday season because not as many people are looking to buy. It's just is what it is. That's our market.
Listen, I think in defense of the real estate business, it's a tough one to price a property anyway, just because everything that you're taking in account. So they were trying to also follow the trend. They were also, so they've got a homeowner that's saying, everybody, I'm watching on TV, you're getting $1 million over asking price on $100,000 property, all of these things. So it is at best a highly educated guessing game, and value is a very broad, wide definition, because you can put an 8,000 square foot home in the middle of a desert where there is nothing around, and it does not have the same value as it does in Malibu. So
Sure.
You're paying attention to that. And I don't want to get off of this, but before we wear him out, I want to ask him about his other business. And the reason I do is because it's kind of selfish. Two things. One of them is I want him to explain what the difference is between blockchain and what the difference in blockchain and crypto. Dan is one of the most intelligent people there is out there, extremely affluent in crypto. But one of the things that I'm really grooving on is blockchain, and I have ever since I heard about it and figured out what it was. But how it's not the same thing. And if you would tell me a little bit about Crypto Charge, tell me a little bit about how it works, and if you would, same thing that Mike said, give me the one-word version of the difference between crypto and blockchain technology.
Yeah, so I have a passion project with some partners of mine called Crypto Charged, which is really educating people on the crypto space, what different projects are that they're looking at, trying to really take something that I think has been made very complicated and it is something new, certainly can be extremely complicated, but listen, it's an art form trying to take something like that and making it easy to understand. And I like to think that we try to do a good job with that. But really the purpose is to help educate potential investors in the space, because I saw so many people, they see, stuff on whether it's Twitter, you name it, getting pushed and pumped, and they kind of jump in and they don't even know what they're investing in. They don't even know what Bitcoin is or any of these altcoins out there. And then, some of these are pull the rug under your feet kind of schemes, right? And basically give them every advantage that they could have to educate themselves so they can make some better decisions out there. And it's also an industry that I think is really revolutionary. And I think sometimes people get a little bit caught up in some of the volatility that we're seeing in the market, and they forget, actually the impact that this is going to have. So, the place I like to kind of start with this is, first of all, cryptocurrencies and the blockchain are different. The blockchain is kind of what all of these cryptocurrencies are able to work on, right? Meaning, if we look at Bitcoin, for instance, right? What is Bitcoin? So Bitcoin is really a new monetary system out there, and it tries to have a lot of differences that I would consider weaknesses in our current system. So we are in a centralized finance system. And some of the stuff we talked about today, inflation and things like that, that's all impacted by the central institutions that you need to have for our system to run. The Federal Reserve, they really control the cost and supply of money. Are they doing that as well as they should? Are they causing inflation? And then you have banks that are necessary middlemen to facilitate the flow of funds in the economy, right? Because most money out there is digital. So how can you create a system that's decentralized that you don't need these players? Well, Bitcoin's the first one to really do it. And, if you think about a bank, right, they have a ledger behind their security wall that, hey, I have Dan Habib's account here. Hey, his direct deposit comes in. Let's credit his account. He swipes his debit card. Let's debit his account. And he keeps a live tally, right? Maybe I sent the PayPal to somebody, a Venmo, whatever it is, right? He keeps track of this, because the big thing that you want to prevent with digital money is double spending, right? Can I go swipe my debit card 10 times and spend more money than I have in there? Well, how do you do this in a decentralized way with Bitcoin without having these banks? Well, the answer is the blockchain. So the blockchain can be used for many other use purposes in this, and real estate and mortgage is one of them. But in Bitcoin specifically, think of that same ledger that your bank has, except it is a distributed, global, and transparent ledger. So instead of one bank that's kind of keeping track of this for you, imagine millions and millions of computers that are using their processing power, and they're plugged into the Bitcoin network. And all these computers are verifying the transactions and accurately recording them to the blockchain. Now, there's obviously a lot more to it, but in layman's terms here, everybody in the Bitcoin network, what they're trying to do with their processing powers and their computers is to be the first one to solve an algorithmic mathematical problem, a hash function, okay?
Mm-hmm.
Trying to solve that math problem so it gives them the ability to write that block to the blockchain. So you have a bunch of transactions. Dan sends Jonny 5 Bitcoin, Mike sends Dan 3 Bitcoin, right? All these transactions, they get grouped into a block, and then whoever's able to solve this math problem fast enough first, they can record the block to the blockchain.
And for the mortgage people, these math problems are a little more difficult than you could handle with your HP12C.
So here's the thing that I think is so cool about the system is that, first of all, okay, well, that sounds great. You can, kind of run this new monetary system without banks, without Federal Reserve. But then also, well, how do we get more supply? And why would these people want to use their processing power, their computers, in order to verify these transactions? And the answer is they're financially incented to do so. So if you are the first to record this block to the blockchain, and guess what? You get all the fees attached to those transactions, and you also get a reward in Bitcoin. The current reward is 6.25 Bitcoin. So, imagine getting, what's the price of Bitcoin right now? Let's just say it was $20,000, $150,000 reward you get for keeping the network secure. So the byproduct of keeping the network secure is you get a reward in Bitcoin and fees attached to it. So the incentive's in the right place. But that's also the only way new Bitcoin is actually created and brought into circulation. So there's no Federal Reserve saying, hey, we need to go ahead and create more dollars out there digitally to stimulate the economy. No. But also, Bitcoin is one of the most finite hard assets that we've ever seen. People try to compare it to digital gold and stuff like that, but there can only be 21 million Bitcoin. So far, over 19 million have been mined. And then here's the other thing. Instead of inflation going up like we see in our current economic system, inflation, it's actually going down in the Bitcoin network, and it's at a very set, predictable schedule. So right now, if you look at how the protocol works for Bitcoin, every 10 minutes, the difficulty of the math problem adjusts. So, or I should say this, the difficulty, the math problem in the Bitcoin protocol adjusts so that approximately every 10 minutes you have a new block written to the blockchain. Well, if you just do the math, that means that there's going to be 144 blocks per day at a current reward of 6.25 Bitcoin. That means that the supply of Bitcoin increases 900 Bitcoin per day. But every 4 years, that reward gets cut in half. So the next halving cycle is 2024, which means that come 2024, instead of 900 Bitcoin per day supply, it's going to be 450. And then come 2028, 225 Bitcoin per day. So you actually see the inflation going down until you finally get to the year 2150, where the last Bitcoin ever created will be created. But just think about that from, an investment standpoint, from a supply standpoint. You have adoption and user accounts going like this. Even through this bear market cycle, we're seeing a ton of new accounts being created, and then you have supply like this. So listen, not financial advice here, but in my humble opinion, I think we're going to see the stock market go down. I'm saying 3,200 on the S&P as we go through this recession. I think Bitcoin's going to go down, I don't know, $12,000, $14,000. I think that, if you believe in what I'm saying here and you look to the future, not tomorrow, but over the next, few years, I fully expect Bitcoin to be well above $100,000. So I think that from a risk-adjusted investment position, I think it's one of the most exciting. And I think, personally, I'm going to be buying with both fists once we get to some of those levels. And I think Ethereum is going to be, in the $500 range. So I think that people will look back and be like, man, that was really a multi-generational investment opportunity there. But to your point, Jonny, it's much more than just an investment asset, right? So the way that the blockchain is decentralizing things and making things faster, cheaper, more accurate, I think is going to have a similar impact to how the internet changed business and really changed everything that we do. And remember, in the beginning, exactly. And remember,
I think it's going to be a massive. I think if you're not on board very soon with blockchain, with Web 3.0, with what's coming up, I think that the difference between leaving the silver standard and going to fiat currency is going to be a joke compared to how fast and how much this is going to change the world. Now, the other thing is we've got this recorded where Mike, and I assume you've got this recorded where Dan said he's going to send me 5 Bitcoin. So let's keep that.
Yeah, but he had me sending him 3 back, so I don't know if I want to put that in.
Dude, if he's going to give me 5, I'll give you 3 just to make him happy.
Okay, all right.
He's down 2. You and I, I'm good with that.
So, yeah, we can cut that. We can cut that part out of it.
Okay.
But I do think that if you want a good laugh, if you pull up YouTube and look at the people that said that the internet was crazy.
Oh yeah.
There's like some great videos of people on some of these networks that we were just talking about where they're like, what do you think about this internet thing, man? I don't think it's going to
fad.
Right. It's a fad. So, but now, especially kids today, right? I mean, it's second nature, and we couldn't imagine doing anything without the internet, right? If you can take away my phone, but if you take away my internet, I can't do anything, right? I think it's going to be that revolutionary with the blockchain.
You've never known a world without.
Right.
Where my generation, we knew a world without, and there's so many. I was actually talking to our social media manager, Bethany, yesterday about this. The fact that your generation, she's in your generation, has never seen a world without, and the inefficiencies. It still blows my mind, the inefficiencies we have in our system just in buying a home, in buying a property, not only listing it, when you get to that, but even the mortgage, getting that, and the inefficiencies that go along with it. And nobody really knows if it's going to close or not until after you get your keys.
Mm-hmm.
Because even up until the last minute, and we try and say that how up to date, and we put these stop gaps. We're pulling a credit report on somebody the day that we're going to closing to see if when all of this is already in a system and it's already triggered. I am so excited about seeing blockchain come to our industry. I cannot.
All it's going to do is make things infinitely quicker and easier for borrowers.
And accurate.
That's all it can do.
Think about it, Mike. You're out there where you guys are at, and you're pulling permits to have extensions put on your house, things like that. You don't know until almost the very last minute. So I'm out here as the buyer, paying for an appraisal, paying for an inspection, paying for a survey, and we get down to it to find out you never got that back living room or family room or man cave permitted, so it's not legal. I can't buy your property. You can't sell me. And how much money are we already out by then? And how much time? That I am so excited about this coming to.
And the ancillary industries, I think of that a lot too. Because the first thing I thought of, and when I heard of blockchain for the first, what's blockchain? I read about it for about 15 minutes and said, so this is going to completely kill the title industry.
Oh, so much. Not only just the title business.
It's unbelievable. Just that in itself, an uncrackable ledger that exists for the public to consume. That's what you're paying title companies for access to, for the sale history of a home. Just from that one little aspect. Borrowers don't have to buy title insurance anymore. Nobody has to pay for a title search.
What about appraisals? Where day before yesterday it was $450 for an appraisal. Now it's $1,200. I'll get to it when I can. And we already know the address. We already know what it's sold for. We already know the appreciation in that area.
Yep.
We already know if permits were pulled. Why do I even need to go through this? What did we just go through for the past 2 years with appraisals? And nobody is waking up in the morning saying, I want to be an appraiser. It's not happening. So, and here's where one thing.
The business kind of turns into creating the best search tool in order to return those records from the blockchain.
Amen.
Yeah, I mean, I think
and where I
a lot
came
of
up
the
with it, where I got it from, was listening to Dan, because up until that point, I did not realize, and this is probably going back, I don't know, a year and a half, it may be 2 years ago, when Dan started talking about it publicly and telling people, and then he would say something. I'm like, oh, I didn't realize that. I didn't know blockchain was something that was different. I didn't know. And I didn't know the difference. If you would say what the words are, Dan, because I don't remember. What's the difference between Ethereum, Bitcoin, and then you were talking about in one of the things that I watched about Dogecoin and the ones that were
yeah, utility is what, Bitcoin and Ethereum, those actually have like real world cases. They actually have utility versus, looking at Dogecoin and, Shiba Inu and stuff like that. Those are like shit coins, or kind of like a meme stock, a meme coin, right?
Meme coin. That's what you were saying. Yeah.
Yeah. But I think that, I think I think it's going to be hard to see some of those people 100% replaced, at least in the intermediate term, because there's still things that, you might need title agents or a person for, that the blockchain can't necessarily, assume. But by and large, I think a lot of the processes that they're doing, or a lot of the roles that they're playing, are going to change. I don't think that real estate agents are just going to be completely replaced, by the blockchain. But I think that a lot of their roles are going to be made a little bit different. I think things are going to be cheaper, more efficient, more accurate. I mean,
easier.
I think, and easier. I think, if you look at title, I mean, even with title, I mean, there's like, I don't know, I think it's like 20% of title has like defects, at least maybe 25%. Yeah. I mean, that is a big growing pain part there. We have to take all the title from all these public records and put it into a blockchain. But once it's, into a blockchain, I mean, imagine if instantaneously, not knowing, having to know personally the person on the other side of the transaction, but imagine being able to know who owns the property, if there's any liens on it. And then how about this? I mean, you talk about like a blockchain being used as like escrow or something like that, right? I mean, so one of the things that's exciting about things like Ethereum and some other, blockchains and cryptocurrencies out there is smart contracts, right? Which means that it's literally programmable smart money, right? So imagine if, somebody puts up into the blockchain like some docs that, and you don't need wet signatures. You can digitally, let's say, if you could, first of all, you have a digital identity, right? But you could have a digital signature that will automatically release, let's say, the title, and also release the funds to the other party, right? So you can have like a lot of these different things happening automatically through the use of the blockchain. But one of the things I like to think about too is like the bigger picture with blockchains. And that's that, if we talk about us, we are in a civilized, well-to-do nation here, right? I mean, but there's over 2 billion people out there that weren't fortunate enough to be born into an area that has infrastructure, right? So that means that they don't have an identity. They certainly don't have a net worth, right? In many of these areas, it's hard to believe unless you travel and get some perspective that it's like some of these areas like a barter system, right? So, how hard is it to think about, you got Elon Musk with Starlink launching satellites, into space, having like worldwide global Wi-Fi coverage. And then, Moore's Law, how expensive is it for a cell phone company to give a new customer, based on the lifetime value, a free cell phone? Well, now you have 2 billion people through the use of that technology, but then also the blockchain, that they can actually participate in the global economy, have an identity and things like that, right? So there's some things that I don't think are that far off seeing happen.
And using cryptocurrencies, which are global assets, you don't have to worry about people talking about exchange rates and what's worth. It's worth this there, and it's worth this over here, and this is just the same for everybody.
But I think possibilities are endless, and I almost think, I like to think about it like this, right? It's like right now we're speculating on some of the things that are going to happen, but when steel was invented, right? It was like, okay, we can build like some bridges now, we can build different things, but nobody, when this was invented, thought that we were going to use it to build a spaceship, right? So it's like right now we're being given different building blocks, and I think that we can't even imagine what it's going to be used for in the future, but it's something that is going to be really impactful and really significant. And to Johnny's point, this is an area where, you want to be proactive and not reactionary.
Mhm.
And this is coming, whether you like it or not.
Yep.
So, the more ahead of this and in the know and educated you can be, I think it gives you a big leg up to your competition out there, because, you don't want to be scrambling, trying to understand. Listen, there's a saying, change happens faster than we can ever imagine. Right. And I think that this is something that you're not looking at like 10 years down the road, but in in the shorter, over the next couple of years, right, you're going to see some pretty big changes due to this technology. So I think it's important that you put in some education there and learn.
And where can they go again for more of that information, Dan?
Well, there's a lot of great resources out there, but if you want to check out the company that I've created, it's called Crypto Charged. www.cryptocharged.com. If you want to sign up for a 2-week membership to kind of check it out, would love to have you on there. But no matter where you're getting the information, I just think it's important for you to put some time and dedicate that.
Amen. One more question for you before we go. What the hell is fungible?
Fungible, Johnny.
I'm picking.
Yeah. So, something that's fungible means that it can be like duplicated or like recreated, right? So, when obviously Johnny's joking and referring to NFTs or non-fungible tokens.
Mm-hmm.
So NFTs, again, one of those things that you don't want to just pay attention to how that market from a price standpoint has gotten crushed recently, but what it's going to be able to solve in the future. And there's so many different instances of how this can be so big. Real estate, they're creating NFTs with real estate, right? So, the ability to buy these things, buy fractional shares, mint them, and then anytime there's a transaction in the future, you get paid on it. But, people, I think, have a hard time understanding it unless they really try to open their minds a little bit more. Let's put it this way, right? An NFT is basically digital ownership, right? So, if you talk about the Mona Lisa, there's the original Mona Lisa, which is essentially priceless. But then there's like a million copies of the Mona Lisa, which aren't worth very much, right? But people out there, they're like, well, there's an NFT for the first tweet. There's an NFT for the original YouTube video of something happening. There's an NFT for a digital playing card. Well, why does that have value if I could just watch the video somewhere else or I can copy that? And it's like, well, you have to change your perspective where people are, this is like artwork of the future per se, right? And it doesn't just have to be art. So don't just close your mind to that. But what I'm saying is that it is, instead of owning the original physical, you're owning the digital certificate essentially for the digital version of something. And that has value. And it's, the value of like the future, in my opinion, right? Like, I don't think in the future, you're not going to have like, I have a bunch of still playing cards that I get a kick out of actually looking at, some basketball cards, baseball cards, football cards and stuff, right? But I think kids are going to share that digitally now, as opposed to like, in physical cards, right? But you can use NFTs for so many different things that we need a whole nother show to get into it.
Yes.
But it's really having a digital signature, digital ownership of something.
It's all built on that smart contract, right?
It is. And,
and that contract can be written to say anything. It can be it can be tickets to an event. It can be digital ownership of.
It could be music where that person, where that artist is no longer getting screwed out of getting money for their songs, and it's automatically built into it where they're the minter of that song or whatever. And anytime it gets played through the blockchain and smart contracts, that artist is automatically getting paid. And you just there's also some cool like crossover stuff where it's like you have NFTs in the blockchain crossing over into the real world. And Gary Vee does some of this stuff where it's like you can buy an NFT for like his restaurant. And it's like, if you have that NFT, and you can actually get a seat in the restaurant and stuff like that. I mean, there's so much stuff that's going to
VCon. You buy an NFT, you get into every VCon. It has a value. There's only so many of them. You can sell your NFT. One of the things that I wanted to leave this with NFT is because that's something that's coming as fast, if not faster. But one of the things that I'm really excited about. So my whole life growing up, I've heard the after, and I'm so glad you brought up music. I've heard the after stories on whether it be VH1 or whatever it may be, Access TV, about the label wouldn't let us do what we wanted to do, or the Metro. I probably shouldn't say that. The film studio would not allow a specific actor or a specific title or something like that. And the golden rule: who has the gold makes the rules. One of the things that's going to happen with this, and it's going to happen, and I think it's probably already happening, is now you don't, if in today's age, if Dan wanted to make the movie Rocky, he doesn't have to go and beg and borrow and steal and put up his life and sell his dog and all of these things. Yeah. If Dan wants to, he doesn't have to bow down to somebody who really doesn't know anything about his story. Dan can now do a crowdsourcing type thing and sell part of his NFT to the crowdsourcing, and they can get royalties and so forth. Now they can own part of that movie, part of that album, part of that song, and get the royalties off of it in perpetuity. That's one of the biggest things that I'm so excited about.
Yeah, no, you're spot on. And, for those in the real estate space, there's places that you can go and buy fractional shares of a real estate property, an investment property. Mm-hmm. And then, if through the smart contracts, you get your pro rata share paid from the rent. So, there's all kinds of changes, even just specific to our industry that you're going to see. But guys, what a great conversation today, man. I really appreciate this. We'll have to do this again. And Mike, it's good spending some time with you too, brother.
Likewise, man. I look forward to seeing you next week at the conference, and
big time.
We'll pick it back up then.
Well, guys, thanks so much. It was an honor to be with you guys, and we'll talk soon.
Thank you so much.
Thanks, guys. Everybody out there, appreciate you tuning in to this episode of Fly the Flag, and we will talk to you, see you. You'll hear from us next time.
Thank you so much,
guys.
Take
care, everybody.
Bye, guys.
Bye.